Hi, I'm Peter Lundgren, founding CEO at Lundgren's Capital.
And I'm Mel Lopez, Chief Economist for ASEAN.
Welcome to Sound Economies with Mel and Peter, an East meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hello, Mel. Welcome. How are you today? How's your week been so far?
Hi, Peter. We're coming from a series of holidays in Manila, so we are feeling refreshed and ready to take on the many, many economic headlines that we keep on monitoring. It's been an action-filled weekend, apparently, as far as markets are concerned. How about you, Peter? How are you this last week of August?
Yeah, I'm doing good. As you say, it is exciting as well. Fed and everything. It's busy. So everything's good, and good. You're back from a very long weekend. Yeah, it was nice, probably. Let's jump into to some of all the interesting stories around the world that we pay a bit attention to and are using as building bricks in our also advisory of wealth clients and running our own positions. So first, we will revisit Indonesia. They are setting up let's call it a fund, a government-run fund, investment fund. And then we turn to what we here in the company call the real stuff, and that is actually as far away as New Zealand. Interesting comments, and they're sharing some insights from their sovereign fund, that is a true government-owned fund, investment fund. And then we, of course, we had, as you mentioned, Friday we had from Jackson Hole, Powell speaking, and we got some hints about how Fed is thinking, how is he thinking. Of course, that is extremely important. We need to touch base there. And France is heading towards difficulties, maybe again, and is actually it can be serious. We recommend investors to keep an eye on it. And as always, we end up doing a global wrap and see how much sunshine there's left out there. Are we still positive on the world? So, Mel, what's going on in Indonesia and what is the fund they're doing now?
Right. So a pretty unique scenario that we're seeing in Indonesia. They did open a government controlled fund just a few months back, and now they're using that to raise funding for the government, but it's far from market rates, which is very unique. So just by branding alone, they're calling it the patriotic bonds because they want to convince businessmen to lend money to the government for government programs and public spending in general at rates which are much lower than the market. So these patriot bonds will be on offer in October. The target is about $3 billion. So split evenly in 5 and 7 year tenors. The catch is they want to sell it at a 2% coupon rate when the market rate is at 5.7 to 6% for 5 to 10 year bonds. So
Yeah.
the unique thing here is that they're trying to ride on the very high approval rating of the Subianto government. He is the chosen successor of longtime President Jokowi. So Joko Widodo is very popular, and this guy is also very popular, and they're really counting on patriotism, also known as strong political support, to raise money for Indonesia. So they are in the process of convincing big business tycoons to basically invest suboptimally just so they could fund the president's programs and projects, and that includes free meals for children and pregnant women, socialized housing, and infrastructure. So it is looking like a goodwill slash throwaway money to keep the ties close. And there is initial data that suggests that they've already talked to the big conglomerates in Indonesia, and they've received commitments of like 2 to 3 trillion rupiahs per conglomerate. So in
Yeah.
dollar terms, that's quite low. A trillion rupiah is about $60 million.
Mm.
So okay, but it will be for sale by October, and it is something to watch out for, especially at the time when yields elsewhere you could fetch much
Yeah.
higher, basically triple the rate if you invest it elsewhere. So it is a very odd, unique situation where they're trying to raise funds, Peter.
Yeah, as across the world, there
Mm-hmm.
are different kind of what we would call off-balance public financing ideas and good attempts, and it also in different ways, not via such a fund, but it also happens in Europe. And we notice that Indonesia is a bit sort of on our radar screen for being, I would call it, creative in different ways. Unfortunately, creative in a way that we do not really approve. And there have been a couple of things lately that we see that it is actually trying to deal with an economy that is not as sharp as it should be. And
Mm-hmm.
actually, also the things you refer to, what they want to do with the fund is to simply to increase public spending and nothing else. It is not. It's not even going to sort of reform the economy.
Yes.
It's just handing out cost. So if a client should come into our office, we and ask what we think, we will probably be skeptical about that investment opportunity. And that I can
Go to the
disclose.
market.
And we are not so happy if we look into sort of the general assessment of Indonesia. And
Mm-hmm.
it's a huge economy it's a huge
Yes.
country, big population. It has an importance in Asia. So that is also why we actually cover the issue, because in Southeast Asia we should not have Indonesia to tilt, so to say. That would be unnecessary. So we notice the sort of investment initiative, so let's call it that way. But if we move a bit further out in the Pacific and go to New Zealand, there the true a true sovereign fund, and that is actually as a money saved by the government into a fund as we know them around the world. We also know from the Norwegian oil fund, and of course in the Middle East, each and every oil-producing country, they have their own sovereign funds, and that is the piggyback, so to say, of the country. And this is always extremely interesting to learn what are these funds doing, because they're big.
Mm-hmm.
And one thing about the New Zealand uh, sovereign fund is that if you're looking into return, they are actually the best performing of the sovereign funds.
Yeah.
And it's always good to listen to the people who are in the lead. That has never been wrong. And the two co-chief investment officers have been bit in the media here, telling about what sort of one move they have done. It's Brad Dunstan and Will Goodwin are the two gentlemen's name, and thank you for sharing the insight about what they're doing. And what they have done is actually to overweight European equities and underweight US equities. And that is interesting. It's not extreme, as they're not doing something completely extreme. It's compared to their own benchmark, it's overweighting Europe with 2%, but after all, underweighting US with 3.5%. And
Mm-hmm.
that is a step, because we would tend to overweight US stocks in global portfolios. What we've done ourselves, sort of, already last year was to cut US back to neutral.
Mm-hmm.
So we have moved the same way. Where they argue for what they've done is solely equity valuation. So it means that they are, when they talk about European stocks, they talk about the stocks Europe 600 index and in general US stocks. So this is what they look at. In their assessment is that the European stocks are trading below fair value and US stocks are trading above fair value. And of course, when they are talking about valuation, they're looking very much on the price earning as the PE ratio. And where they refer to the 27.5 PE ratio in US in average compared to the European 16 in PE ratio on that index. And that's a huge difference. Now, is that equal to just say, okay, sell US stocks and buy European stocks? No, it's not. First of all, US companies are simply better to earn money than Europeans are. They are also better to squeeze the assets, and that is why it's so difficult for a European company to buy a US company, because in Europe we are not used to squeeze the company as they are, as it's take out the last drop. That's another story. To use the P as solely, I mean, I would say it's difficult, yeah. But they also argue, after all, they do come with a macro, at least one macro hint, and that is that the US inflation, rising US inflation, that will over time become noise. And then we agree with another thing that they say, and there we agree a lot. And that is they have, it seems, also increased their allocation into private equity. And they reckon that the European private equity market offers good opportunities. And exactly as what we did when we to lower the US holdings in the stock portfolio was exactly to go into the non-listed market in Europe as the private equity market, venture capital market. And this is what we continue to argue, that this is where we find more agility among companies. We argue that it can be this what they see as a low PE on European companies, the large European companies, but the large European companies very much reflect the very static development we see in Europe. The organizations are too huge, too heavy. They are still dependent on the macro outlook for Europe, and it is bad. It is,
Yeah.
if we should be lucky, it is just flat as a zero. This is we would include more macro view and saying, okay, macro is certainly not the most decisive for a direction on a stock market. That is the earnings, the company earnings.
Right.
But still, with the outlook there is in Europe, the big companies it will be a drag for these companies. We'll miss the agility. So this is why we say, okay, we like the private market, what we call non-listed market, and there we agree a lot. So very interesting to learn from as a real
From the best.
as a sovereign fund, but also the people who actually are taking the decisions, that they share this very openly. Again, thank you for that, and it's good inspiration. Yeah, so that was the view from New Zealand, or at least the sovereign fund. It's very interesting. Anyway, Mel, as mentioned in the intro, we had a very big important happening, and that was last Friday. Powell, he spoke at the yearly Jackson Hole Symposium. So, are we happy about what he said?
Yes, we are very much happy. Actually, it's the hottest headline for us in this podcast, more than the Taylor Swift engagement. It's really the very strong statement from Fed Chair Jerome Powell saying that monetary policy in the US has indeed become restrictive. So he's basically opening the door wide open for a rate cut in 3 weeks' time. So that's in September 16, 17 from the Fed. There is also an admission of a very challenging situation, and we like that it basically aligns really well. We can say we predicted the timing very on point as far as the cut is concerned. Although there is debate now, so the debate now rather is not whether a cut or no cut, but it's now about the size of the cut that will come in 3 weeks' time. We have very recently said that from a no cut scenario, we're now seeing a 50 basis point cut in September. We do see the reason why Powell didn't really hint at the size yet, because there will be key economic data coming in the next few weeks. So that inflation data, as well as another round of jobs data, which is, of course, a very tricky balance, which they're trying to navigate right now. Our basis for the 50 basis point cut call is the 3 months of weak jobs data. If there is a fourth, For sure, the size of the cut will be likely as big as we saw. And when you navigate that with inflation, which remains above 2%, well above the 2% target, it does complicate the decision making a little bit. And then add to that the curveball from Trump piling on the pressure for the Fed to cut. And then there's news about him trying to fire a governor for not I won't say baseless, but there's no investigation yet. So it is very clear that um the pressure is on. Really, it's even more tense than usual because of the very uncertain situation at the Fed. But we do welcome the statements from coming from Jackson Hole this year. Very different from a year ago. And it was about this time last year when Powell also hinted at the start of the rate cuts from the Fed. And maybe this is a deja vu, Peter.
Yeah, it will be extremely exciting. We are fully aware. The market consensus right now is 25 basis point cut. It's not now. We have held back for almost 12 months here.
Yeah.
And then say, okay, now it's time to move. That's the main reason for saying, okay, why could we consider a 50 basis point cut? And that is because the past 3 months of labor market data really surprised negatively. So the revision was that was actually pretty heavy,
Yes.
and there's a very good chance that if Fed had if we consider the data now as the truth, then the data in July, it was absolutely an option that they would have cut 25 basis points in July. So there is a risk of again, as we also argue when we talk about 50 basis point cut for the first time, that Fed cannot be behind the curve. And this is the risk is if they only cut 25 basis point on the back of maybe another batch of weak labor market data, we don't know, that's speculation, then they could be criticized for actually being behind the curve. And they would basically pretty fast be forced to say, okay, yeah, we cut enough, we come with another cut. Of course, Fed is fantastic in guiding the markets. And what they could choose to do is say, okay, we cut 25 basis points, but actually the outlook is we cut another 25 basis points next time. And then they have sort of guided the market to the 50 basis point cut. That is absolutely an option. But we are extremely excited in the company. Yeah, following each data point that we can get and whatever comment, because now the comments from the FOMC members, they start to be very interesting if they do say something. But we can't forget good old France. They are truly, when we're talking about the economic situation, simply creating a lot of problems for themselves. Now, the 8th of September will be interesting because there is a confidence vote in the parliament. And it's actually the Prime Minister, Francois Bayrou, who called for that. And it is on the back of deficit cutting, so to say. As a proposal is about cutting the deficit on the public budget, and it is enormous, and they are missing every year, as they are running around 5.5% in deficit of GDP. The max to compare as well, decided by the by the EU is 3%.
3%, yeah.
But that is sort of the less serious. As the most serious is actually the actual 5.5% deficit, and it is static. It is not just a one-off. That is so unhealthy for an economy. It is leading to an unstable situation. It is not sure that the government will fall on the 8th of September. It's very open, actually. And that's why it'll be extremely interesting. And there'll be a lot to follow if people are looking a bit into French politics, to follow up till that date and see where people are moving, heading in the parliament. But it is a risk. It will be a no confidence vote to the government. And there is talk already now that IMF might have to enter and take over a bit
Quite
of
extreme, Peter. Yeah.
yeah, of the charts. It is so serious. It is, and it's so bad. And we're talking about the second largest economy in the Eurozone. It's hard to say when a country is uninvestable, but the key is, and now, after all, remembering the New Zealand sovereign fund, they are long-term investors, they say, and they might need to hang in here for a long time, yeah, to get some return. A country like France starts to be uninvestable because the return of investing into the country is very low. So, and as the risk simply is rising, investing into a macro negative scenario
Mm-hmm.
and an output that is very difficult to see, and even government bonds will probably increase in the credit spread, yeah, on a country like France, and we'll see more downgrading. It is a risk in particular if it's a no go on the
Confident.
confidence vote. It's heavily serious, and as investors, we need to look into it and maybe even have an opinion about it. So that is it's. I know it's a bit sort of sluggish view to to jump to the global outlook, but it is simply as it is. And almost I say there's no surprise because since the last election in France, the country has been difficult to rule, yeah, simply because of how the parliament is. Mel, is that something somebody in Southeast Asia at all look at? Is it something that is even finding a
Mm-hmm.
headline or?
Well, actually, what I've seen in the past few days is that there are actually think pieces say trying to bet if it's France or the UK who will need the IMF first. So it's really quite shocking to read as far as a reader from a watcher from Asia is concerned, because what's
Yeah,
happening, this is the mature world, this is the developed
yeah,
world, and now we were there a few decades ago. Like, the Philippines was
hmm,
deep in IMF debt. We were bailed out once in a major way, and now it's the other way around. So it is quite concerning. Although locally, at least in this region, we are still very much focused on the US, really. So it's really the more um in terms of magnitude affecting our economies, it's still very much US centric, Peter.
it's also the same. I feel as when I'm in Asia, there was a lot of focus on Europe. People wanted to learn, and because Europe actually simply was bigger on a
Yes.
relative base. Now it has moved and slided, and people don't really understand the EU because as sort of as a it's not really a union, single
Yes.
uniformed political union, yeah, in in a classical way, and economically it is sliding in importance, and it is hard for investors to see the upside, yeah, as it's too much to extent, yeah. So it's the same I explore when I'm in Asia as out with you.
Mhm.
People are looking Pacific wise. Anyway, how much sunshine do we see out there? Are we happy or are we unhappy when we take the global outlook as a last thing?
As bleak as that conversation sounded, Peter, we still do see much sunshine in the global outlook. There remains to be shoots of growth, especially as far as Asia, China, Southeast Asia is concerned. The US, although they're treading very fragile situation right now, there remains to be some demand or consumption that is supporting growth relative to like the Europe, where flat growth is desirable already. So yeah, when we say we like risk, we are selective about it, and we know what to look for as far as choosing where to make our bets. And yeah, we are still very much upbeat, and especially towards Asia and the Southeast Asian region, Peter.
Yeah, exactly. And as the things like what happens in Europe and France, so it is absolute clouds on the horizon. It's not a good story. But globally, we see the world as still pretty strong. We like them as a private households, though they are getting a bit weaker in Europe actually, and we do see some pressure on households in the US. But anyway, we still see the drive forward. in the global economy. As you say, particularly Asia, there's no secret. We like to overweight risk still. We do see, in general, also equity markets going up. We like credit risk. We like emerging market risk from Asia. If our forecast about a 50 basis point US rate cut comes through, or an indication of another soon 25 basis point, it will still fuel the stock market. But we've had this call, so this positive call in the world is older than the podcast because we've had it since Q4, so to say, in 2022. So we are entering an almost 3-year call on as an overweight risk and being positive on the flash market. It has been a fantastic journey. We are aware that assets are a bit higher priced, let's put it this way now. But still, we remain to overweight risk. That is absolutely the case. So we're happy for the world, despite the clouds out there, and we hope that our listeners will profit from that. And thank you for listening to all the listeners as well. We're happy to be here also next week.
Thank you, Peter, and thanks to our listeners.
We will be monitoring global developments and will share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Lundgren's Investor Insights. Thanks for tuning in. For expert insights on the go, download the Lundgren's Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top-rated mutual China fund. To know more, visit lundgrenscapital.com.